In this lecture, we're going to talk about how to manage risk in your pair trading and mitigate large losses to have the least impact possible. No matter what trading strategy you use, at some point losses will be occurred and periods of underperformance will happen. So you must have defined parameters which you can trade within. Having a solid risk management plan helps define your trading limits, so you're not prone to making bad decisions in the heat of the moment. By knowing what your maximum risk is, you'll be able to align your expectations more closer to actual results and make it mentally easier to trade. The goal of any risk management plan is to contain the chance of any trade or group of trades blowing your account up. Everybody will develop their own risk management plan according to their risk tolerance and objectives. What we will describe is a guide you could use or tweak yourself. In pair trading, we determine our trading sizes relative to our account balance. Ideally, you want about 10 to 30% of your account in each leg of a pair trade. For example, if your trading account balance was $20,000, your ideal position size would be between $2,000 to $6,000 per leg. For example, if you were going to buy Coke and short Pepsi at 20% exposure on a $20,000 account, you would buy $4,000 worth of Coke and short $4,000 of Pepsi. Doing this, we protect ourselves from blowing up our account due to any significant adverse overnight price moves. For example, if a stock opened down 50% using 20% account exposure, your overall account would be down 10%, a significant loss, but not a catastrophic one. Now, fortunately, a stock opening down 50% overnight is a very rare occurrence. More common is stocks opening down 5 to 10%. In this case, your account would only suffer a 1 to 2% loss. Your total exposure should be between 200% to 600%. For example, on a $20,000 account, using 20% stock exposure, you could have $80,000 in total exposure, which would mean a maximum of 10 pair trades open at any time, because that's 4,000 total on a pair trade. 4,000 per leg of the pair trade times 20 positions. If we weren't market neutral, having $80,000 in net exposure would be crazy on a $20,000 account. However, we always have equal amounts of longs as we do shorts, so big moves in the market or sector shouldn't affect us adversely. Remember, our biggest risk in pair trading is stock-specific risk. That is, some unforeseen news event coming out on a stock we hold a position in. No system is able to predict when some unforeseen use might come out. The only thing we can do is keep our risk exposure small to each stock so that when it happens, we don't get wiped out. And again, everybody is different, and you'll develop your own risk management plan according to your own objectives and risk tolerance. But for good practice, we don't recommend having more than 40% of your account exposed to any single stock. So on a $20,000 account, you should never have more than $8,000 exposed to any one stock. So if you're layering into a pair trade or opening multiple pair trades containing the same stock, you should size smaller. This means if you get 5 trading signals on pairs that happen to all contain the same stock, you should ideally pick the best trading signal to trade on instead of taking all 5 signals.